Mr. Keki Mistry, the Vice Chairman of the country's largest home mortgage lender, HDFC Limited, joining us on the phone line right now. Mr. Mistry, we've had the talks of linking loans to external benchmarks. It started in December 2018. The RBI made it voluntary, asked the banks to do it themselves, gave them a deadline of April 1st, 2019. Didn't happen. And now they've come out and said it's mandatory by October 1st. How have you read into this step and how positive is it?
Well, the way I see it is that when interest rates go down, obviously borrowers will be big beneficiaries. But rates that go down will also at some point of time start going up as economic activity picks up. So the volatility that customers will have in terms of lending rates in the new regime will be a lot higher than what they had in the earlier regime. From a lender's perspective, from the perspective of someone like HDFC, currently this is not applicable to us because this is applicable only to banks. But having said that, our ALM committee will meet in due course and we will take a call whether we should introduce a product similar to this and keep the option open for a borrower to even take a loan which is benchmarked off a more stable benchmark where rates do not fluctuate that sharply. So we'll take a call on that. And we'll probably see if we can come out with two benchmarks.
Which was going to be my next question. They've given them 4 options: the RBI policy repo rate, the government 3-month treasury bill yield, the 5-month treasury bill, and any other benchmark published by the Finance Benchmark of India. Now, within these 4 choices also, the volatility of each of the instruments also varies. So, how does one align then according to that? If there are some banks that go in for the repo...
Well, the way to do it is not to look at whether the rates move sharply or move less sharply. I think the more important thing is to see is how quickly your liabilities and how effectively the liabilities can be shifted to an external benchmark. You can shift assets to an external benchmark only after you shifted liabilities to an external benchmark. So the Treasury people will have to work out which external benchmark is the one which is most stable, where it is easier to shift liabilities, and then that benchmark will be the benchmark that will be used for assets. My off-the-cuff view is that it will be the repo rate, but that's my off-the-cuff view. The Treasury people will have to take a more calculated call.
Mr. Mistry, good morning. Neeraj here. Would rates reduce immediately for existing home loans unless customers are at maybe a higher rate of 10%?
Well, I don't know about that, whether rates will stop. Customers, I guess, may be given a choice to move to a new state, to a new benchmark, but I mean, if I, as an individual, would prefer my cash flows to be more known rather to have a more volatile regime where in the short term rates go up and the long term rates go higher. So, it depends on each customer. It's left to the choice of each customer. So we'll have to see whether we give the option to existing borrowers to switch to a new product if and when we come out with one.
Actually, sorry, that was going to be a question. I know the dynamics are different, but do you think NBFCs would follow suit on their own on a voluntary fashion to such a mechanism?
I can't talk for all NBFCs.
About you, sir?
Only for HDFC. I have just mentioned to you in the beginning that our ALM will look at it and see whether we can have an alternate product which is linked to an external benchmark.
Mr. Mistry, one final word from you. Transmission was the key issue with regards to, how much the RBI has been cutting and how much is actually being passed on. Does this materially solve that problem?
Obviously it does, but as I explained to you in the beginning, rates that go down will also go up. So when rates go up, the transmission to borrowers in terms of their having to pay a higher rate will also be a fact.
Leave it at that, Mr. Mistry. Thank you so much for taking the time out and speaking to us.